if you're an option seller and if you heard somebody say, sell options that are 45 days out because that's when Theta really accelerates, they're kind of wrong. And in this video, I want to kind of demystify that and kind of debunk it. Now, when they say that, they are correct. At 45 days out, 2 months out, Theta does start to creep out. Like if you look at a chart of Theta, it's going to look like this. And when it starts to go like that, that's 45 days out. However, Theta is not like a car where you accelerate and then you're kind of smooth sailing. It gets faster and faster and faster and faster every single day as the time goes on. And it's more than the day before. So I'm going to show you this just so you don't have to think of all this boring math. But just remember that Theta decays a higher percentage of the option price every single day. So a higher percentage than yesterday. So, okay, let me show you this. So this is a cash secure put calculator. This is from Option Scout, the software that I built. And let me just show you, explain this. So let's go 45 days out, all right? Let's do 45 days out and let's choose somewhat at the money. So let's go 150. Making 37% ROI. So that's, and how that math is happening, I'll explain to you a little more in details, but you're taking the net credit divided by the cash secured amount. So in this case would be 650 divided by 150. Well, obviously 100 shares. So anyhow, I don't need to bore you. Now let's go to a week out. Okay, 1 week out is going to give you an ROI of 75%, a higher return on investment. So you're like, whoa, wait a second. Maybe that's just a fluke. Let me go to 2 weeks out. Okay, let's go this, 150. So that has less than this, but still greater than 2 weeks. And you're going to see that practically the ROI is going to go lower and lower and lower and lower as time goes on. We can go really, really far. Let's go out to February. Okay, let's do 150, 18%. So you can see it keeps getting lower. So then now you have to ask yourself, why would anybody sell far out of the money options? Well, this is going to depend off of your goal in mind. So if you're only shooting for ROI and only shooting for the highest amount of premium possible, it is better to do weekly. However, if you have a target price in mind, if you have, I want to buy the stock at 130 or 135, or let's say you're a cover call seller and you only want to sell your stock if it goes above 15%, 20%. The issue that you have here is that if you're setting that target, you might be so far out of the money that Theta has really eaten up the contract where you're going to get practically nothing. So here's actually a really good example. Let's say cash secure put, you want to buy Apple at 135, and that's a pretty big dip, right? That's $15 off, so that's roughly, it's like 16% or so, maybe 16, 70% down. Like that'd be a good correction with Apple. Now, if you do that like expiring today, like you're going to get practically like nothing, right? I mean, you're literally going to get 1 penny. So in that case, like, okay, you're definitely not going to get a higher ROI because you're getting practically nothing. And that's because the probability of that option expiring is so low. So that's factored into the price. But let's go to 1 week out, 135. You're collecting $16, $17, and you're getting an ROI of 6%. So that's probably not worth in that case, unless like, you really wanted that. I don't know why you would. But then now this is where if someone is selling options, you are going to be better going further out of the money. Like let's say I go out to January, or let's say we go out to October 28th. That's better. 135. You can see you're actually getting a higher ROI. So that's where you would want to do further out of the price because, and here's why. Time for option sellers is better if time goes on. However, further out in time gives you a lower probability of being profitable. And when there's a lower probability of being profitable, the option price is more expensive. So, and you can think of this logically. What is the odds of Apple going to 135 in a week? It's very, very, very low. That's why I'm only going to get $17, okay? But what's the odds of Apple going to 135 in the next year? Well, obviously way, way higher. And what's the odds of Apple going to 135 tomorrow? It's practically zero, which is why you're going to get 1 penny. So this is where you have to think of what is your goal. What's in mind? Are you just straight up shooting for ROI? Are you shooting for a lot of capital gains? If you are shooting for a lot of capital gains, then yeah, it might be better for you to sell a cover call that is way, way further out of the money and further out in time. So that's why. But because of the fact that Theta gets faster and faster each day, then that's it. But if you're doing this on options that are kind of close in the money, so you're talking about a couple percentage points, obviously depends on the stock. Like if you're doing this on a meme stock, you know, you might be able to go still somewhat further out the money. But again, it just comes down to probability. So if you're trading on a low implied volatility stock, it's not very volatile, you know, you're gonna want to probably choose further out of the money compared to if you are doing a volatile stock, it might be okay to be closer in the money. So anyhow, or at the money. That's about it. So that's why. Comes down to numbers, comes down to stats. If you like this video, please give a like, and I'll see you in the next video.